Welcome to the Ellsworth Advisors monthly update for March 2024. I'm Kelly Keenan, this is Cameron Mealy. Today we will discuss what's been happening on the economic front and then also review what's been going on with the markets and our portfolios and kind of our thoughts moving forward. Cameron, why don't you kick it off with some economic data?
Thank you, Kelly. As we've talked about the last several months, we continue to be on Fed Watch 2024. Still trying to determine a path for Fed, which means a path for interest rates. Obviously, a lot of the discussions, anybody who's been watching the news, is the Fed is still on very much a wait and see mentality. They really want to see the numbers prove out before they do anything. I think it's safe to say that we're past interest rate increases. We're now looking for the first interest rate cut. And again, wait and see approach to the Fed. So let's talk about some of the numbers the Fed's been looking at. The Consumer Price Index. On March 12th, the Bureau of Labor Statistics reported the Consumer Price Index increased 0.4% in February, and that's after rising 0.3% in January. Over the last 12 months, the CPI has increased 3.2%. So still above the Fed's target of 2%, but significantly down from what we've seen post-COVID. The other big number, and this is one that most people quote as kind of the Fed's Bible when they're looking at their inflation numbers, is the Personal Consumption Expenditure Index. On March 29th, Bureau of Economic Analysis reported that the Personal Consumption Expenditure Index increased 0.3% in February after rising 0.4% in January. And year over year, the PCE index is up 2%. So it's finally hit that target where the Fed wants it to be. So inflation certainly appears to be coming down. The economy from a GDP standpoint appears to be slowing down. On March 29th, Bureau of Economic Analysis reported GDP in 2023 increased at 2.5%. So we saw some big swings in GDP. Third quarter was a huge blowout number. Fourth quarter was very strong, 3.4%. But overall for the year, we're at 2.5%. And how are we looking for the first quarter? Again, as of March 29th, the Atlanta Fed and their GDP Now model is forecasting first quarter GDP to increase at a 2.3% annualized rate. So once again, things look like they're trending in the direction the Fed wants to see. The biggest news we're going to see this week is going to be on Friday, April 5th, and that's when the March jobs report comes out. The consensus estimate for jobs growth in March is 216,000 non-farm payroll jobs, with the unemployment rate falling slightly to 3.8%. So I think right now, we're certainly not going to see the Fed's next meeting is in June. We're not going to see any movement from now and then. It would take an amazing economic disruption for the Fed to take any sort of action. So fully, the expectation now is we're wait and see, get to June, see how the numbers come out over the next couple of months. Chairman Powell will come out with his statement. That should give more direction. But I still think the consensus is that we could be looking at 1 to 3 rate cuts in the second half of the year. I'm looking more at 1 rate cut, probably towards the end of the year. And it's interesting. So there was an article, again, March 29th. This is from Jonathan Levin, and this was in Bloomberg. And it's a long quote, but I'm going to read it all because it is interesting. Levin says, policy choices will only get hairier if Powell, Fed Chairman Powell, and I are proved wrong and inflation remains stubbornly elevated for months more, extending the rate cut waiting game into autumn or beyond. And while the macro data is strong today, there are plenty of areas of vulnerability across the interconnected global economy. China is wobbling, and Europe's growth is anemic. And many central banks are loath to lower policy rates ahead of the Fed, raising the risk of an economic accident that starts elsewhere but ultimately lands back in North America. The Fed's mandate only concerns prices and unemployment at home, but policymakers can't ignore the global implications. So we keep focusing on what's going on here, inflation, jobs numbers, and GDP. But obviously, as the largest economy in the world, it isn't interconnected. The world is very flat now. We have seen weakness in China. We are seeing no growth in Europe, the European zone. The BRIC countries that led a lot of the growth in the past 20 years aren't really seeing anything. A lot of, obviously, instability in Russia with the war in Ukraine. So there's a lot across the global economy that could affect the U.S. and ultimately lead to the Fed making a rate cut decision based on softness elsewhere that will eventually become a contagion to the U.S.
A lot going on, and I guess what makes a market is differing opinions and the way people look at the different numbers. A lot of talk on inflation. I mean, it's kind of the hot button right now. That a lot of the, that's being covered a lot in the media. There's not much else going on right now, so that's kind of the big thing to talk about, and the fun parlor game of, is the Fed going to increase rates or decrease rates? The reality is as long as inflation is elevated, and the trick with inflation, or the conundrum with inflation, is there's so many different ways to measure inflation. So are you looking at core? Are you looking at CP, the consumer, the core inflation, or CPE? Those different measurements take different aspects out of the different elements of inflation away, whether they're removing food and energy
or seasonality.
And the reality is inflation, it's like squeezing a balloon, where if you push one side down, it pops up elsewhere, and that's really what's happening. And the other reality of it is inflation affects different people in different ways. If if you're a young person, don't have a lot of health issues, inflation in healthcare really isn't affect you, versus if you're 70 years old with health issues, it's affecting you more. So everybody kind of has their own inflation gauge as to, are they feeling it or not. So the broad-based economic numbers can be a little bit misleading. The reality is in some places it's going down, then it's popping up in other areas. Energy costs are rising again. We're seeing commodity costs in general going up, and there's different things driving that. One of them, Cam talked about China in that quote. Well, looking in the rearview mirror, things have been slow in China, but are they changing trajectory? There's some analysts believe that things are starting to improve in China. If things pick up, that's going to increase energy demand in the world. Okay, now you have energy prices going up. So here's another. So if you're only looking at a measure that's deleting energy from the equation, CPI looks low, or inflation looks low. You add it back in, it's actually there. So we're in this dynamic where, I think inflation's with us for a while, and when you factor in GDP on top of that, GDP minus inflation, the U.S. economy is, I wouldn't call it great, I wouldn't call it bad. It's it's decent.
Yeah.
And depending on where you're moving around in the economy, what you're looking at, you're going to two different industries, businesses in the same economy could be looking absolutely different. We're definitely not in a rising tide, or a tide that rises all boats or brings all boats down. So, selectivity is going to be important, and I'm pretty optimistic for the year. I don't think much is going to happen on the rate front. If the Fed reduces short-term rates, it's going to be, probably towards the end of the year, unless there's a major dislocation, big crisis that comes up. Longer-term rates, actually, you look at 5, 10, 30-year, they actually make sense where they're at for the longer term. So, it's an interesting dynamic that we're stuck in. This dynamic actually tends to be pretty good for the stock market, and dovetailing into how things have been going so far this year. For the month of March alone, it was a good month. The S&P was up 3.1%. For the year, it's up 10.16. The Dow Jones up 2.08 for the month. For the year, it's lagged the S&P, but that's up only 5.62%. The Nasdaq, which has been in 2023, the big winner, actually only up 1.79% last month. Not bad, but just not leading the pack. Year to date, up 9.11. Small cap stocks in the month of March up 3.39 as measured by the Russell 2000. And year to date up 4.81, so a decent month for small caps. Seeing some life in international markets. The EAFE for the month up 2.78%, year to date up a little bit over 5.06%. Emerging markets still, kind of lagging the pack. For the month, only up 2.18%, year to date up 1.9%. So markets in general, great start to the year for the first 3 months, so it's a good first quarter. Last year was a pretty good first quarter. Kind of ran into some rough patches midway through the year, but obviously we ended well. When we talk about our portfolios, our growth with income portfolio, kind of our balanced portfolio, for the month up 3.8%. Year to date up 9.2%, so off to a good year. Driving that portfolio, NVIDIA up 14% for the month. Talked about energy a little bit. Exxon was up 11.2%. EOG Resources, which is more into the natural gas arena, up 11.7%. And Disney, we're seeing some signs of life there, up 9.7% for the month. Laggards, Nike's been struggling a little bit, down 9%. Apple down 5%. Johnson & Johnson down 2%. Year to date, NVIDIA up 82.5%, kind of the gift that keeps on giving. Toyota up 37%, one of those things that people haven't thought about, but car business is doing fairly well, and especially Japanese. I mean, Japanese stocks have done pretty well. We've been kind of riding that wave with Toyota. Berkshire Hathaway up 18%. Year to date, Nike's down 13%. Nike's been challenging, really for the last 18 months. And, that's been a dilemma for me. Do we, walk away from it or not? I still think, as a company, as a brand, it's one of the world's coveted brands.
Maybe Apple and Nike, the two biggest brands in the entire world.
And we saw this with Disney. Disney was a laggard, but now Disney's definitely helping the portfolio. That's why we have a diversified portfolio. Sometimes things work, sometimes they don't. But if they're good balance sheets, eventually they do work, and they help us out when we need them. So Nike down 13%. Apple, down 10.8%. So Apple's kind of going through one of its periods of underperformance. It's going to happen. That's Apple's history. So at some point they'll outperform again, but we've made a lot of money there. And Honeywell down 1.6. Dividend yield portfolio for the month, good month there, up 4.15%. Year to date up 9%. So dividend yield kind of lagged last year. Made money, but nothing to write home about. This year off to a great start. Caterpillar up 9.7% for the month. Eaton up 8.5% for the month. U.S. Bank up 7.7%, Prudential up 7.7%. Where we kind of lost some ground in March, McDonald's down 3.5%. Verizon, which we walked away from, down 0.2%. Gainers for the year, Eaton's up 30%, Caterpillar up 25%, Merck's up 22%, Waste Management up about 19.4%. So Merck was up. Pfizer, we walked away from Pfizer, down 3.5% for the year. So we've kind of stepped away from them. For the year, even though McDonald's had a good, McDonald's down 4.4%. So once again a bad March and not so great year to date. And let's see, appreciation with income for the month. A big winner here, up 6.9%. Year to date up 10.6%. We have some financials in there. Actually, Vistra up 28%, Equitable Holdings up 11%, Kenvue up 13%, Lamar up 9%. Really, the only laggard in there is Union Pacific, down 3%. Year to date, Vistra is up 81%, Merck's up 21%, JP Morgan 18.5%, Equitable up 15%. So definitely the financials driving that portfolio a bit. Price potential portfolio. Laggards year to date, Public Storage down 4%, Santa Fe down 2%. In the price potential portfolio, typically this is our strongest performer long term. Decent amount of turnover in there, so a lot of activity. Off to kind of a slow start this year. We had a good March, up 3.2%, but year to date we're up only 6.6%, but starting to gain some ground. Gainers, Deere up 13%, Agco up 12%, Allstate up 9%. Laggards, Heartland down 6.4%, Amphastar Pharmaceutical down 5.7%. Big gainers year to date, Interactive Brokers up 35%, Allstate up 24%. Renaissance Re, which is a reinsurance company, up 24.5%. Once again, you see some theme with the financials outperforming. Laggards, Integra Life Sciences down 19%, Genpact down 4.7%. Amphastar, we bought late January, we're down 21%. Obviously, we picked up some ground there last month. In our small cap portfolio, this is where we have some fireworks. Actually, we're doing pretty well compared to the index. For March, we're up 3.6%. Year to date, up 10.5%. So good movement out of small caps. the reality is the small cap index is vast, 2,000 stocks. We're only buying 40 stocks at a time, so a lot smaller selection, and we can be a lot more. We're buying companies that are actually making money. March gainers: Taylor Devices up 41%, UFP Technology up 21%, NC Nino up 25.3, US Lime up 17%, laggards: Nuvalent down 10.7, Esquire Financial down 6.5, Vaxcyte down 7.5, Covenant Transport down 4.8. Year to date, Taylor still leading the pack up 125%. IES Holdings up 51%. Powell Industries, which we sold last week, year to date was up 60%. I think overall since we bought it, probably pushing 200% on Powell Industries. Laggards: Consolidated Water down 17. Now we've made money in Consolidated Water over time. Winnemark, which we sold last week, down 16%, and Clearwater Analytics down 14%. So, in general, great month for the portfolios. Like I said, I like the setup for the year from a stock market standpoint. We've had a good run. Like every time we can always have a pullback at any point in time. Little weakness the last couple days. Interest rates on the longer end moved up a little bit, but like I said, I think there's going to be kind of range bound.
Kelly, you commented, it's particularly in this month, there has been not a lot, but there's been more selling activity than we generally talk about, positions we've gotten out of. Maybe just explain to everybody what triggers a sell for us.
Depending on the strategy we're using, so we kind of rerun our numbers once a week, and because we limit the number of stocks in each strategy, when we rerun the numbers, if we don't like what's going on, or the stock's not performing as we expected, or the numbers aren't coming in as expected, that might be a company we want to take out of the mix, and then we're going to replace it with another company. So anytime we sell something, we're going to buy something, or if we want to buy something, let's say a new stock pops up that, hey, we'd really like to get into this. If we're going to add it to the portfolio, then we have to find somebody we're going to get out of the portfolio. So that's why, especially in the price potential and the small cap portfolio, there's a lot more turnover in there, because those are also geared towards, we're looking for outperformance the next 12 to 18 months. So we're not going to sit on things forever. Little longer term orientation, like in the growth with income portfolio, that, we give the stocks a lot more runway there. So those are going to be longer term holds. Dividend yield, same thing. They're going to be longer term holds, because they're bigger companies, very solid balance sheets.
It's like turning the Titanic with those companies.
Exactly.
With the small caps, they get hot, they pop, they get to the return threshold. We think the stock is going to hit. It's time to replace it. So I think the important thing to note is that all of this is done without passion. It's done based on fundamentals, based on company fundamentals, market fundamentals. And when our models say that a stock has changed and it's time to move on from it, we move on from it.
But it's not strictly numbers based. I mean, the numbers give us, okay, this is what it's looking like. Now we have to make the decision, okay, are there other catalysts that can drive things, especially in those higher turnover portfolios. So I think, I don't know, I have much more to say. It's a little bit boring, but boring is good from a performance standpoint. And at least in the next couple of months, bar a correction. We haven't had a 2% correction yet this year, so we're kind of due for one. Like I say, every month we'll see what happens. Yeah.
And but, it is a presidential year, so we're going to see some volatility. We're going to see a lot of noise in the news. Obviously, if you have any questions about your account, if you have any financial questions at all, feel free to reach out to any member of the Ellsworth Advisors team. We appreciate your trust, and we look forward to speaking with you again next month.
Thank you.
Thank you.